The Cecil Booker Vending Company changed its method of valuing inventory from the average cost method to the FIFO cost method at the beginning of 2009. At December 31st, 2008, inventories were 120,000. That's based on the average cost basis, and were 124,000 a year earlier. Cecil Booker's accountants determined that the inventories would have totaled 155,000 at December 31st, 2008, and 160,000 at December 31st, 2007, if determined on a FIFO basis. A tax rate of 40% is in effect for all years. 100,000 common shares were outstanding each year. Income from continuing operations was 400,000 in 2008 and 525,000 in 2009. There were no extraordinary items either year. Okay, now the first requirement says, prepare the journal entry to record the change in principal. And it lets us know that all tax effects should be reflected in the deferred tax liability account. So let's tackle that part first. Alright, so what we need to do is compare the 155,000 potential inventory value at December 31st versus the 120,000 on the average cost basis, and determine the change, and then determine what the impact would be on deferred taxes. So this is the calculation that we would need to take a look at. Okay, so there you see 155,000 less the 120,000 gets us 35,000. 35,000 times 40% tells us that we would have a 14% change in the deferred tax liability. So with that knowledge, we can go ahead and book the entry. And the entry would be a debit to inventory of 35,000, a credit to deferred tax liabilities of 14,000, showing the increase in deferred tax liabilities. And then, of course, the difference would have an impact on income in a prior year. So we show that where that would show up on the balance sheet, and that would be to retained earnings of $21,000. Okay, and that's how we tackle part 1. Okay, now let's read the requirement for part 2, which says prepare the 2009-2008 comparative income statements beginning with income from continuing operations and include per share amounts. Alright, well, we've got to do some calculations before we can make that entry. So let me show you the calculations that we would need to make here. Okay, income before taxes in 2008 were $399,000. How we have to calculate that is we take the $400,000, which was given as income from continuing operations, less the $1,000 impact if FIFO had been used to get us to $399,000. Alright, now let's go through the logic of how we came up with that $1,000. If we compare the $160,000 to FIFO versus average of $124,000, which was given in the problem, we've got a $36,000 increase in 2008 from beginning inventory. When we look at ending inventory, we would have had 155,000 less 120,000 using the average cost method, so we would have had a drop of 35,000. So the 36,000 increase less the 35,000 drop gets us a $1,000 change, and that's the increase in cost of goods sold, which also means a decrease in income. Okay, so once we have that information, then we can book the entry. And I think I'm going to run out of screen real estate here, so let me put it on the screen, and then I'll slide up so we can see it. Okay, let me slide up just a little bit here. Okay, and there you go. So what we would show is the $525,000 in 2009 of income before taxes, $399,000 in 2008, and then we back off the income tax expense, which is $210,000 in 2009, $159,600 in 2008, to come up with net income amounts. Okay, and they gave us the $525,000. We calculated the $399,000. The income tax expense, I believe, is 40% of those numbers, and the the only thing left we have to figure out is where did these numbers come from, the earnings per share. Well, we take the net income and we divide it by the number of shares that were outstanding. And right here they tell us 100,000 common shares were outstanding. And that's how we work this problem, everyone. Thank you.